we're all doing good. In today's session, we'll be covering a small concept known as financial guarantee. This topic has been asked, or this comes under financial instruments topic. We have done big topic in day 109, financial instruments. Yes. In that particular chapter, one particular concept, that is financial guarantee, has been which was given earlier. It was not tested upon, but in RTP May 2021 they have asked a question relating to this concept. So in today's session we'll understand a little bit on the meaning as to what it means and how the accounting treatment for this particular concept should be done. Okay, so now I've given you like simple accounting treatment, or what the standard says is financial guarantee. If it is there, initially you should recognize it at fair value, initial recognition. Subsequently, you will recognize at higher of two things. One, the loss allowance, or amount initially recognized less cumulative amortization, or simply you can call it as fair value. Okay, basically loss allowance or fair value, whichever is higher. The higher of the two you will calculate, and that will be the subsequent measurement at each period, reporting period end. You will measure it like this. Okay, so I've written this. If you want, you can copy it in your books. Okay, all right. Okay, now let's understand a little bit about the meaning of this financial guarantee, what it covers. First, let's understand that. Then we will dive into the problem side of things. Okay, now let's say there is one particular person. Let's say he's a BCom graduate. One person, he completed BCom, so he wants to start his own business. Okay, so for that he required a loan. So he approached HDFC Bank. There is one particular person, Mr. X. He approached HDFC Bank and told, boss, I need a bank loan from you. Okay. And he told, I require a bank loan of 10 lakh rupees. To start my business, okay, I require a loan of 10 lakh rupees. HDFC analyzed, they did the risk profiling and stuff. Based on the credit score, HDFC told, okay, fine, we will give you, but the interest rate on the loan will be 15%. Okay. But Mr. X told, hey, that looks pretty high considering the environment and all. Why are you charging me 15%? Okay, normally HDFC, let's say it's a personal loan, they charge normally 10% for the loan. But to Mr. X, they are charging 15%. So X asked HDFC, why are you doing this? Why this unnecessary? Why this collivery for me? HDFC Bank told, boss, look, based on your qualification, your business idea, and we have calculated your credit score and all, based on that risk profiling, okay, since your qualifications and all is not that great, okay, we are taking a big risk, hence the interest rate we can give at best is 15%. Sorry, we cannot reduce further. X told, is there any possibility to reduce interest rate? HDFC Bank told, okay, if any person can give you a guarantee on your behalf, if a person who has a good credit score, high net worth individual, all right, or some person with good net worth, if he can give the guarantee on your behalf, that for this particular loan amount, then we can reduce this interest rate to 10%. HDFC told, we can offer this loan at 10% provided somebody can give the guarantee on your behalf to the bank. Now Mr. X, he remembered suddenly that he worked in a CA office long after qualification for some time. So he went to the CA office and requested his boss, this is a scenario. Okay, if you give me a guarantee, then I'll get the interest at 10%. It will be of big help to me. Can you? Okay, normally CAs don't give that. Okay, let's say that is Mr. Y. All right. Y told, no problem. Y was in a good mood and all. So he told, fine, I will give the guarantee on your behalf to HDFC Bank. Okay, Y agreed for this particular arrangement. Okay, so that means X will be able to avail this loan at 10%. Okay, so X, we will have to pay actual interest at the rate of 10% to HDFC Bank, whatever is the interval, maybe quarterly, yearly, whatever. He has to pay that. Okay, so now we are not talking about X ka books here. We are talking about for Mr. Y. Y has given a guarantee to HDFC Bank. Yes or no? What guarantee? That if Mr. X defaults on the loan, then Mr. Y will have to pay 10 lakh rupees or the default amount to HDFC Bank. That's the guarantee which Mr. Y has given. Yes. Now, if you think about it, now for Y ka books mein what journal entry or what accounting treatment should we give for this particular guarantee given. That is this concept. Okay, that's what we mean by financial guarantee. Hope the meaning is clear. Okay, somebody has given a guarantee on your behalf. In this example, it is Mr. Y. So in Y's book, what accounting treatment we should do is what the funda we are studying now. Okay. Now simply if you think on it, Y unnecessarily took one extra liability on his head. Yes. One obligation is there on Y ka head. Yes. Because if Mr. X defaults, then Y cannot escape from his obligation. He's already given a guarantee that he will make good the default amount to HDFC Bank. So that means one obligation is sitting on Mr. Y ka head. Yes, that obligation is nothing but your financial liability. So basically, Mr. Y has to record in his books financial liability in the form of guarantee in his books. That's all. Fair enough. So Y has to record this liability in his books because one obligation is sitting on Y ka head. Next funda is, sir, at what value will it be initially recorded? Because let's say the loan ka term is 3 years. Then initially when you give the guarantee at year 0, meaning at the time of agreement, okay, you will record financial guarantee at what value? That is your initial measurement, okay? And each reporting period end, that is year 1, year 2, year 3, at what value should this financial guarantee be accounted? That's all we are about to study, okay? Fair enough. So we're not worried about Mr. X ka books here. Now if you relate it to a practical example, see, if you think practically, okay, so any random guy, any third party, if you approach and ask to give guarantee, nobody will give that. Yes. So if these sort of transaction is to happen, like if you want to take a loan from bank, who will give the guarantee on your behalf? Maybe your dad, your mother, or your relatives, or your brother, like this. You're a known person. Yes. So if you just retrace this or rework this example, instead of X, you can make it as X limited. Instead of Y, you can make it as Y limited. Two companies. Why will Y limited give guarantee on behalf of X limited? There has to be some relationship. Yes. Meaning YX could be our subsidiary company and the Y limited could be the holding company. So practically this scenario will come if holding company has given guarantee on behalf of subsidiary company to any particular banker or anyone. So in holding company books, that is the person giving guarantee, in their books, what should be recorded? So you'll record one financial liability because one obligation is there which you cannot escape from. So the name of that financial liability is, financial liability guarantee you can write, or financial guarantee you can write. Okay. So that one needs to be recorded. So now at what value, how it should be accounted and all that we will learn numerically with the help of our RTP problem only. Okay. So basically with this intention of this chart was just to explain you what is the meaning of it. So let's understand the number activities at what value it should be recorded with the help of this particular question. Okay. This is question number 15 that is there in RTP May 2021. This question was asked. So let's take up this question and understand that. 1. On 1st April 20X1, Sun Limited guarantees 10 lakh rupees loan of subsidiary. So Sun Limited is the parent company. So subsidiary has taken a loan and parent has given guarantee. Loan amount is 10 lakh rupees. So parent has given guarantee on subsidiary's behalf. Subsidiary ka name is Moon Limited. Which bank STDK, that's the name of the bank, who provided to Moon Limited for a period of 3 years. So the subsidiary has taken a loan at the rate from that particular bank for a period of 3 years at 8% interest rate. Okay. Alright. The interest payment had to be made at the end of each year. Okay. The principal is repaid at the end of the loan term. That is 3rd year. So every year you need to pay interest. At the end of 3rd year, you will also pay the principal amount of 10 lakh rupees. That is the arrangement. If Sun Limited had not issued a guarantee, then a bank would have charged Moon interest at the rate of 11%. If the holding company had not given guarantee to the bank means, then the actual interest on the loan would have been 11%. Because of the guarantee, subsidiary got a good deal. They were able to make some savings in the form of interest. From 11%, they got a better deal at 8%. So 3% they are able to save in the form of interest. Yes. 10 lakh is the loan amount, 3% they are able to save every year. So that is 30,000 is the savings in interest each year that subsidiary is able to make because of this, because of holding company giving the guarantee. Okay. We'll see what to do for that. Sun Limited does not charge Moon Limited for providing guarantee. Okay. Now you think practically. Okay. if you approach a third party, random person, forget about holding subsidiary company, okay, the person taking the loan, he has approached a random person saying, can you give me guarantee? All right. Will any random person give any guarantee without if there's no benefit to him? Now, if you approach a random person, what will the random person say? What's in it for me? Or why are you asking me? Suppose I told him, see, if you give guarantee on me, my behalf, then 30,000 interest I will save every year. And the loan term is 3 years, guys. That means how much will be the savings in interest? First year 30, second year 30, third year 30. That means totally 90,000 I can save in the form of interest if somebody gives a guarantee on my behalf. One simple question that somebody will ask, what is that? Why should I give guarantee? What is the benefit for me? Yes, that means I have to give him something, correct? So he will charge something from him, only then he will give guarantee. Yes. So will he charge 90,000? No. Yes, though I might be saving 90,000, right? At the end of first year I will save 30. At the end of second year I will save 30. At the end of third year I will save 30. That means from year 1 to year 3 put together I will save 90,000. So I will not give him 90,000 entirely now. Yes, because this 90,000 is a saving I will do over a period of 3 years. That means this is a future value. Correct? So if it is a third party, then what will he say? He will expect something from me. He will charge something from me for giving guarantee. Okay, not entirely 90,000 because this 90,000 is a future value. So we need to find out the present value of this 90,000. Okay, that is the fair value of guarantee initially. Okay, because this is what he will charge from me. Correct? So I will have to find out the present value of this 90,000 rupees. Then I will get the the value of the guarantee as of now. So that much money I'll have to pay him for giving the guarantee. This is what normally, if it is an unrelated party, means this would have happened. Yes. But here, since the loan has taken by subsidiary company, holding company is saying, you need not pay me anything for guarantee given. It is fine. You are my bacha only. Okay. So it is okay. Alright, no problem. I will give the guarantee and I will not charge a single penny from you for giving this guarantee. If it was third party, we would have to pay him something. Not 90,000. Alright. We would have to pay him because this 90,000 is a saving for a period of 3 years. So find out the present value of that. Okay. Fine. If you find out the present value of 90,000, then you will get the value of the guarantee that you should have paid him currently. Okay. So that is not there in this case because it's a holding subsidiary wala relationship. Okay. On 31st March 20x2, that is the end of first year, there is 1% probability that Moon Limited, that is a subsidiary, may default on the loan. So there is 1% chance that they may default on the amount. If subsidiary defaults, then holding company has to pay them for the default amount, right? If Moon Limited defaults on the loan, Sun Limited does not expect to recover any money from Moon Limited. So if they default means entire 10 lakh, the holding company has to pay to the bank because Moon Limited, they're saying we will not be able to recover anything. 100% they will default. Okay. So if they, there is 1% probability that they will default full amount. Full amount is 10 lakh. So if they default, then entire 10 lakh, the holding company has to pay to the bank. This is the position at the end of year 1. Year 1 ending. Okay. On 31st March 20x3, that is year 2 ending. Okay. There is a 3% probability, I'll box this also, this is important for us, 3% probability that Moon Limited may default on the loan in the next 12 months. Okay, second year may probability percentage has become 3, it has increased. Okay, if Moon Limited defaults on the loan, Sun Limited does not expect to recover any amount from Moon Limited. So if the default means full 10 lakh, again holding company has to pay to the banker. Provide the accounting treatment of financial guarantee as per Ind AS 109 in the books of Sun Limited, that is the holding company, on initial recognition and subsequent periods till 31st March 20x3, only till the end of year 2, because you took the loan from 1st April 20x1, right? Yeah, you took the loan on 20x1, so 20x2, 20x3. So only for 2 years they are asking the accounting treatment in holding company ka books. Okay. So I will solve this question under a particular method. Study material has worked it out under a different method. Later I'll tell you why I did not follow study material. Solution will be the same, just the way of working is different. I will tell you both we will understand, then you can follow whichever you are comfortable with. Okay, so let's take up this question number 15. Okay, first working note I will put is the savings in interest. Savings in interest. Okay, you can put it in one line, we have already calculated, because instead of 11% loan, you got it at 8% loan. So 3% is a saving in interest every year. Yes. So maybe if you want, you can show it in little more detail. So year 1, year 2, year 3. Okay, first one. What would have been the actual interest? If the guarantee was not given, means interest at 11% would have charged. Yes. The loan amount is 10 lakh. You would have to pay, subsidiary had to pay 11% interest to the bank. That would have been 1,10,000. Okay. Because of this guarantee, the actual interest is charged at 8%. So the actual interest you are paying is only 80,000. So the savings in interest, call this as C. The savings in interest, that is 3%. Yes, that is nothing but C is equal to A minus B, which is 30,000 rupees. Either you can get it directly, okay, or you can show this as a working note. Study material has done this working note just to be in sync. I've just solved that, okay, or you can directly write it. Absolutely no problem. 10 lakh ka 3% if you do, anyway you're going to get 30,000. So principal amount is not changing. You're repaying principal only at the end of year 3. So second year also interest you need to pay on 11% itself. So this will be 10,000. So actual interest is only 8%. So this is 80,000. So savings for second year is also 30. Savings for third year is also 30 itself. Okay. So this is the savings in interest. That is my first working note. I think this is pretty easy for everyone. Okay. All right. So now, since holding company has given a guarantee, they have an obligation sitting on their head. So they have to recognize a financial liability. The name of that financial liability is financial guarantee. Okay. So one working note I will do. Then we will pass off, or we will do the journal entry accordingly. So where, or we will write financial guarantee or financial liability hyphen financial guarantee balance. Each year or initially and at every year end, how much I should recognize financial guarantee is what I am trying to calculate. Okay. So particulars, you took the loan on 1st April 20x0. That is the date on which you gave guarantee. No? So that is your initial recognition. So this is your initial recognition. And then subsequent recognition they are asking for only 2 years. So that is next will be 31st March 20x1. Okay. Then it will be 31st March 20x2. 3 ka, they have not asked the data, so I think we can leave it at this. Meaning 31st March 20x3 ka data I meant. Okay. So I will calculate the whole solution. Okay. In this particular table. This is an important table, so watch out. Okay. First, I'll calculate something known as the fair value. Because initially we know that financial guarantee, we just now learned that financial guarantee is measured at the fair value. That's what Ind AS 109 generally talks about, right? Initially, all the financial asset, financial liability are recorded at the fair value. So we are trying to find out the fair value of this particular component, that is financial guarantee. That you already know, we've discussed it here. Yes. See, holding company has not charged any money from subsidiary company. Okay, that is the reality. But Ind AS runs not on the what the actually things have happened. It is a principle based standard or substance based legal form accounting, right? Substance over legal form accounting. Reality is more important than legality is what Ind AS talks about. Yes. So in reality, though holding company has not charged from subsidiary any money for giving this guarantee, but if the same transaction if you are done with third party, would that third party would have given you the guarantee at free of cost, or he would have charged? If you had asked to give third party some guarantee, he would have obviously charged some money. Yes, like you ask the bank, if you remember, issues something known as BG, bank guarantee, right? So for issuing BG on behalf of a client, on behalf of a customer, they will not give it at free of cost. They will charge some commission. Yes or no? So like that only. If you had done a transaction with third party, how much he would have charged for this, providing this guarantee? That's what he would say, right? Third party would say, since you are saving 90,000 rupees, 30,000 at the end of year 1, 30,000 year 2, 30,000 at the end of year 3. Okay, this 90,000 is your total savings, but 90,000 you will save over a period of 3 years. Find out the present value of this. That only is your fair value at the time of initial recognition. So find out the fair value, the present value of this 90,000. That's all. So So if I have to calculate this, okay, it is 30,000 at year 1, year 2, year 3, right? So like putting this table here. So I can calculate, like how do I find out the present value? I take the discount factor, yeah? For first year, what is the discount factor I will take? Second year I can take, third year I can take. Or since the cash flow is same, yes, the savings amount is same, I can use annuity factor, no? Instead of doing the present value interest factor, I can use present value annuity factor. So take 30,000, do present value annuity factor at the effective interest rate, meaning if the guarantee was not given, what would have been your interest rate? If guarantee was not given means the interest rate would have been 11%. Yes. So because of guarantee it is reduced to 8. But otherwise this would have been your interest. So you take this particular rate at 10% or rather 11% for 3 years. So calculate PVIF. 1 divided by 1.11. 1, 2, 3. 3 times you do it and press grand total button. You're going to get 2.4437. Okay. So if you do this into 30,000, if I do, my calculator is showing 73,311 rupees. So the present value of that is 73,311. Though the savings may be 90,000, but you will save that 90,000 over a period of 3 years. The present value of that is 73,311. So that is this, or this 73,000 is the fair value of the guarantee on the day you entered into this particular contract. That is on 1st April 20x0. So fair value on this particular date is this particular odd amount. So if you want the journal entry, next page, maybe simultaneously we'll go off the journal entries also. Journal entries in the books of holding company, that is Sun Limited here, right? So if you look at the journal entry, we'll maybe do it in columnar format. Particulars, first year 1, year 2. They only asked year 1 and year 2, right? So we'll only give it for 2 years. So on 1st April 20x0, yes, that is the day on which you entered into all this. 20x1 in fact. 1st April 20x1. Holding company has given a guarantee. That means one obligation is sitting on top of their head. So that means you need to credit. An obligation means you have to record that obligation, right? So it's a financial liability. So we'll credit to financial liability, that is financial guarantee. Financial guarantee as per my working note number 2. What is the value of working that amount? Initially you will recognize it at 73,311. Okay, you have to debit something, right? Holding company. If they had received this 73,000 in the form of cash, they would have written cash account debit. Yes. But did the Sun Limited, that is the holding company, did they charge anything from subsidiary? They told you are our subsidiary only, you are part of us. So we don't want to charge you any money. Okay. So if subsidiary does not charge any money for giving guarantee to subsidiary guarantee on behalf of subsidiary company, then in the books of parent, it will be considered as an investment made in subsidiary books. That is, what is the name of that subsidiary? Or you can write it as investment in subsidiary account debit. Okay, remember we had done this in share-based payment in days 102. Okay, group share-based plan. So if parent gives shares on behalf of to subsidiary employees, we used to debit investment account. Because it is interpreted as the parent has made some investment in subsidiary company. Okay, because subsidiary obligation they took on their head, no, and they're not recovering also. So you will write it as investment in subsidiary account. Okay, so why can't I write subsidiary account? See, you can always write like Moon Limited here, right? So you can say, sir, why can't I debit Moon Limited account? See, if you debit Moon Limited account, then it will look like Moon Limited is your receivable. So that means it becomes your debtor, receivable. Yes. So is holding company receiving any money from the subsidiary company? Do they have any intention to charge? No. So you can't make them as a debtor because you will not be recovering any money from this. So hence it will be treated as the parent has made an investment in subsidiary company. Hence investment in subsidiary account will be debited to the extent of 73,311. That is the first journal entry. Hope that is clear for everybody. This is your initial recognition on 1st April 20x1. Okay. Alright. So that's the first thing. They not only asked initial recognition, they also asked at subsequently at each year end what you're going to do. That's the same funda. Okay. First find out, now you found out the fair value at initial recognition, right? Similarly, also find out the fair value, okay, at the end of first year and second year, because you have to recognize it at fair value, right? Now, you are at the end of first year. you took the loan on 1st April 20x1 or x1. Okay, 20x1 to 31st March 20x2. This is your year 1. Then year 2 will end on 31st March 20x3. Then year 3 will end on 31st March 20x4. Okay. So on this, when you found out the fair value, what did you do? Every year they are saving in the form of interest 30,000, 30,000, 30,000. 3 years saving. So you found out the present value of this 30,000. Okay. Using that on this particular date. Now same fair value you have to find out on 31st March 20x2. Now how will you find out? Now again will you take 30, 30, 30, 90,000 find out? No, no, no. 1 year is already gone. No. Now at the end of first year, if you do the same arrangement, like at the end of first year, if you take a loan, which you have to repay by 31st March 20x4, from here to here if you count, the period is only 2 years. So 1 year is already over. So if the loan term is 2 years, and if you ask a third party to issue guarantee on your behalf for a loan for a term of 2 years, what will be the fair value of the guarantee? You will save 30,000 for the loan term. Yes. So 1 year is already gone. So the loan term remaining is 30,000, 2 years. So 30,000 you will save again, and 30,000 again you will save. Each year you will save 30,000. So 2 more years is remaining now. So to find out fair value, what will we do here? Same. Savings is 30,000 only. But now you will find out, since the cash flow is same, savings is same, instead of using present value interest factor and putting table, we'll use shortcut method. Present value annuity factor at 11% only, but this time only for 2 years, because 1 year is already gone. No? So no, I mean that's the reason. Like you'll save only 60,000 because the loan term is 2 years, right? 30,000, 30,000. So 60,000 you can save, but that 60,000 you will save over a period of 2 years. So you're trying to find out the today's value of that. So which is the present value. That's what we have done doing. So 1 divided by 1.11, 1, 2, if you do grand total, my calculator is showing the value as 1.7125. So into 30,000 if you do, you're going to get 51,375. Okay. So let's also do it for this year also, since that way it will be easier. Now, if you want fair value on 31st March 20x2, now x2 nahi, it is actually, this actually should be x1 period, my bad. I wrote the period slightly incorrectly. I'll change that. I think 20x1 when we tip the loan, right? Yeah, guarantee. This is x1, this is x2, and this should be x3. Now, if you want to find out the fair value on 31st March 20x3, what will you do? The loan will end on 31st March 20x4. That means the loan term remaining is only 1 year. So how much will you save maximum? 30,000. So if you ask somebody to give you the guarantee here at the end on 31st March 20x3, then since you will be able to save 30,000, is 30,000 the fair value? No, no, no. 30,000 you will save by the end of 31st March 20x4, at the end of the year. You want the present value, no? Find out the present value. So here it will be what? 30,000 into present value. Now there is no annuity factor, there is only 1 year. So present value interest factor at 11% for 1 year. Okay. So it will be, if you do calculate it, it will be 30,000 into 1 divided by 1.11, that is 0.900. Okay. So this will be what? 30,000 into 0.9, oh, number was wrong. 1 divided by 1.11, 0.9009 it is. So into 30,000 if I do, my calculator is showing 27,027. That is the fair value. Okay, simple. The present value of cash flows I am using. Okay, that itself becomes your fair value. Okay, fair enough everybody. So I have not done the 31st March 20x4 column because they have not asked for it. Okay, so if you want, maybe at the end, if you want, we can run through that also, just for your knowledge sake. Okay, alright. Now, what is the value of financial guarantee, or how will you account financial guarantee? Initially, it is recognized at fair value, but at each year end, subsequently, you will recognize it at fair value or loss allowance, whichever is higher. Fair value or loss allowance, whichever is higher. Sir, this financial guarantee is a financial liability. Which method will we use? Your mind will be thinking on that. Sir, will we use amortized cost method, or will we use FET OCI method, or if we use FETPL method? See, if to use amortized ACM method and your FET OCI method, correct? It should satisfy contractual cash flow test, CCF test. Yes. Here, is there any contractual cash flow? Nothing is happening over here, right? Yes, there is no periodic cash flows that you are getting here. So this financial liability has to be measured at FVTPL, fair value through profit and loss account. But for this particular concept, they also introduced, that's the reason we are saying here fair value, okay? But they've introduced one more concept. At each year end, you will not just measure it at fair value, okay? You will check two things, fair value or loss allowance, whichever is higher you will take. So FVTPL method means why will this loss allowance come? See, if you think logically about this particular method, it's the guarantee given, right? Holding company has given a guarantee to subsidiary. If subsidiary defaults, then holding company has to pay the money to the bank. Yes. So that means, do you think if subsidiary defaults, holding company has to give just 73,000 or 51,000 to the banker in case of year one? No, it could be more. Yes or no? That is the reason they're saying don't just stick to the fair value for this particular concept. Also calculate something known as loss allowance. Okay? Meaning at what is the amount you are expected to pay to the bank. Suppose the amount you are expected to pay to the bank is 60,000. Then showing the liability at 51,375 is not right. You have to show it at 60,000. Okay? So that's the reason here two concepts has been brought in. Fair value and loss allowance. Whichever is higher you need to take. That is the funda behind that. Okay? This is your initial recognition. Initial recognition there is no loss because just now you have taken a loan, right? So there will not be. Initially you will recognize it at fair value. So that number will not come for initial recognition. At the end of each year, right, to find out loss allowance, this is similar. If you remember, we had done, okay, expected credit loss method. Okay, how do you get loss allowance is take the loan amount, multiply it by the probability of default. Multiplied it by the probability of default. Again, multiply it by the risk of default. What is this? I'll tell you. Now let's come back to the problem. They have given certain sentence. Let's look at that. On 31st March 20x2, that is the end of first year, there is 1% probability that Moon Limited may default on the loan in the next 12 months. Okay. So there is 1% probability that on 31st March 20x2, they will default. Loan amount is 10 lakh. There is 1% probability that they will default. So take the loan amount multiplied by the probability factor. Okay. What is this risk of default? See, that is I've written. In fact, this is not there. This particular words is not there in a study material. I've just brought in this. What is this is? Check here. If subsidiary company defaults, okay, they're saying if Moon Limited defaults on the loan, Sun Limited, the holding company, does not expect to recover any money from Moon Limited. That means full amount holding company has to pay. Okay. So hence you will take this to be 100%. Sometimes what happens is they could give, like if subsidiary company defaults, 20% will be able to recover it from the subsidiary company. That means in that case what? Only 80% of this value I need to pay, no? Because 20% I'm able to recover from subsidiary company. So in that case I will write 80%. Like if I'm able to recover 70% from subsidiary, then I only have to pay 30% to the bank, right? So this will be 30% in that case. So in this problem, since we are not expecting to receive any money from subsidiary, it is 100%. So even if you don't mention this in this problem, it will not make a difference. Hence, study material they have not mentioned this. But just in case in your examination, if they change this line, like this particular line, they said, no, Sun Limited does not expect to recover any amount. Instead of that, if they say Sun Limited expects to recover 30% from subsidiary company, then the risk of default will be 30% you will be able to recover. Then this will be 70%. So that case it becomes irrelevant. Hence, I've just mentioned. If the same problem comes, even if you don't mention the risk of default and if you don't mention this 100%, it will not make any difference in this particular case. Okay. Fine. So here, how much you will have to pay? 10 lakh of 1% is 10,000, right? So that means, 10,000 we may have to pay to the banker. This is what we are expecting. This is expectation accounting. All right. So the financial guarantee amount will be recorded at the fair value at year end or loss allowance, whichever is higher. So I'll calculate the higher of the two. Higher of A and B. Which is higher? Initial May, it will not come. So that is fine. Here, higher amount is how much? 51,375. So that means the carrying amount. Okay. We'll do after full working, then we'll pass up the journal entry. Initially, you recorded the financial guarantee at what amount? 73,311. Okay. At the end of first year also, should you show this as 73,000 only? Not necessary, because you will measure this financial liability at 51,375 or 10,000, whichever is higher. So higher amount is 51,375. So you will show this guarantee amount at 51,375. But currently you are showing this guarantee amount at 73 because initially you recognized at 73, right? At the end of year 1, if you show 51, that is sufficient. So there is a difference. What is that difference? If you calculate 73,311 minus 51,375, 73,311 minus 51,375, if you calculate, you're going to get the difference as 21,936. Okay, it is your fair value gain or loss. In FETPL method, if there is fair value gain loss, where it will go to? P&L, right? So amount to be transferred to P&L. Amount transferred to profit or loss, SPL or P&L account, is 21,936 is what you need to transfer. Because you need to show financial guarantee amount at 51,375. At the beginning of the year, you already recorded at 73. From 73, you have to bring it down to 51. So that is that fair value gain or loss that will be transferred off to PRL. So the journal entry for this will be at the end of first year, that is 31st March 20X2. You have to reduce the financial liability amount. No? So it will be FL financial guarantee account debit. FL financial guarantee account debit as per again working note number 2. Okay, how much will you debit it by? How much you need to reduce? 21,936. First year only you're doing all this drama, hence I'm writing in year 1 column only. That will go off to PRL. Okay, 21,936 will be transferred off to PRL account. This is the journal entry you will pass at the end of first year. Simple. Okay, initially recognized at fair value. At every reporting period ending, you'll measure it at fair value or loss allowance, whichever is higher. So same drama I'll have to do it for the next year also. That is the end of year 2 also. Okay now. Alright. So I feel this was easier. So I'm just stuck to this method. This table will give you solution for everything. In study material, we'll just check. So every solution you'll not get it in one table, or here all the data is there in one table. By looking at this, you can pass off the journal entry. Hence I'm sticking to this particular method. Okay. Now same thing, second year mein, you already found out the fair value at the end of year 2, that is 27,027. You just need to find out the loss allowance. Now come to the problem, have they saying anything? On 31st March 20X3, that is second year, there is a 3% probability that Moon Limited may default. Now default has increased. Okay. So 10 lakh is a loan amount. Probability of default is 3%. And they are saying the same thing. If Moon Limited defaults, then Sun Limited does not expect to recover any money from Moon Limited. So 100% they have to pay. Okay, so they'll not be able to recover anything. So risk of default is 100% there. Will not be able to recover anything. Yes. So if the recovery is given 20%, 30%, then this number of 100% or multiplying that would make sense. Otherwise, you can leave it off. It's fine. So that means this is 30,000. So the guarantee amount will be measured at fair value, that is 27,027, or loss allowance 30,000, whichever is higher. So higher of this A and B is 30,000. That means the carrying amount, what is the carrying amount? Carrying amount of financial liability, that is financial guarantee, right? Financial guarantee. That's what I'm writing. That should be same, this 30,000, the higher of the two. But currently, at the end of year 1, you are showing it at 51,000. At the end of year 2, it should be shown at 30,000. So from 51, you have to bring it down to 30. Because as the term passes, your guarantee ka headache also will go away, right? Once the loan term ends, the guarantee will be squashed off like that. So from 51, you have to reduce it to 30,000. So what is the difference? 51,375 minus 30,000 if you do, you're going to get 21,375. That is that fair value gain loss transferred off to PRL. I mean, second year, same entry will come, but for amount is 21,375. That's all. Okay. So this is the entry they have asked in the particular problem. That's pretty much it. Okay. That's all is this particular accounting in the books of holding company. Now, if you want for your curiosity, so what will happen at the end of next year? So 31st March 20X4. This is only for your reference. Huh? They are not asked it in the question examination, so not required. So the fair value of that financial liability will be what now? You are at the end of third year. Now at the end of third year, will you ask somebody to give you guarantee? Now only give guarantee, now only I'll repay off the loan. Will not happen, right? So that means will that have any fair value? No, the fair value of that guarantee will be 0. Correct? Because now only you're taking the loan, now only if you're repaying means there is no term remaining, right? Because you are at the end of the year now. So there is no savings for you. So the fair value of guarantee is 0. Okay. So loss allowances, again, they have not given any data. So obviously the term is ending, so loss allowance is also 0. Higher of the two will be 0. So the carrying amount of that financial guarantee also should become 0. But currently you're showing it at 30,000. So from 30,000, your loan term over. So that means this liability is not there on your head, right? No data is given. I'm assuming subsidiary company did not default. That means entire 30,000 which you are currently showing, you can transfer it off to SPA. So same entry you will pass at the end of third year for 30,000. This they have not given any data. So I'm assuming that the things are smooth. If there's no default happening, then this particular things will transpire. Okay. So that is again just for your reference. This is the journal entry they are asking. Now, if you look at the solution of study material, if you want, we can correlate. One is a working note for savings and interest. That is same. If you initial recognition, they found out the fair value. Fair value of at initial recognition, they found out separately. And then they're putting a separate working note, two working notes, more working notes, they're putting it up. So multiple tables they're preparing to present the same data. Okay. This is same, which we also did. Yes, 73,320. That is not a problem. So initially, if you just check, investment, since subsidiary holding company did not receive any cash, so it will be treated as parent has made an investment. So the journal entry will be investment in subsidiary to financial guarantee, that is liability 73,320, 73,320. Okay. Now if you check the second table, why I did not follow this table? If you just check, pay close attention to this table. We have done this table like crazy. Many problems we have done. Yes. Doesn't it look like ACM table for you? Check year, opening balance, effective interest rate, benefits provided, closing balance. Yes, this is what we used to do. Okay. So this is easier. This we can relate it better now. So why you did not do? It's simple. If I do this particular method, no, the moment I calculate interest rate, one doubt students will ask, sir, this is interest? No. Will you pass journal entry for interest? No. We're not doing ACM accounting here. Okay. This may look like an ACM accounting, but this is FVTPL accounting. So interest will not be accounted over here. If I present, this is another way to find out fair value. Check at the end of year 1. What is the value they've got? 51,385. What is the fair value at the end of year 1 we got, sir? Fair value at the end of year 1. There could be small rounding off error. Don't worry about that. We have got 51,375. They've got 51,385. That is the fair value. It is just a method to find out, or another working to find out the same fair value here, sir. Okay. Because the ACM table is what? Finding out the present value of cash flows. Yes or no? This ACM table is that only, right? Okay. So yes, there's nothing but another way of finding the fair value. So why you did not use this method? Because you will feel we'll have to pass the journal entry for interest. Sorry, this is not ACM method accounting, because contractual cash flow test fails over here. This is FVTPL accounting. Okay. So interest will not be accounted. If you just check, they might have calculated like this in table. If you just check the journal entry, nowhere they pass the journal entry for interest. It should not come also. Okay. So you may get confused, because now you may understand on the examination day, ACM problem also you will be covering, this also you will be covering. So all may look similar and you may get confused. You may feel one problem is calculating interest and accounting, another problem is not accounting. So that sort of confusion may arise. To do away that, I am not preferring this particular table. Okay. And this table is not comprehensive, because financial guarantee should be valid at fair value. So each year end at fair value or loss allowance, whichever is higher. That means if you follow this table, another working note you need to put for loss allowance, which they've done. Check. The loss allowance is 10,000 rupees. That's what they've done. Okay. So it is 51,385 or 10,000, whichever is higher. So that means they're doing another working note. Okay. So this note is not actually comprehensive, but our working note was comprehensive. It covered everything. If you want, you can use this also. I've done it horizontally. You can use a vertical approach. After closing balance, see whatever working note I have done here. No. Okay. Like loss allowance, higher of the two, carrying amount. All this you can write it on the other side of working also. Like here you can write loss allowance, etc., etc. You can write and finish it also. The number of the width will become bigger. Okay. But you may get confused with respect to interest portion. That's the reason. Like I did not follow this method. I just followed the other one. But answer is matching. Check. They have transferred to P&L 21,935. I think we also got the same thing, subject to round off. 21,936 we got 1 rupee. All right. Next year we got 21,375. So they have also got 21,385. Round off error. Okay. So that's the reason I preferred this particular method. Not that this is wrong or anything, it's just that like it may create some unnecessary confusion for you. To avoid that, I've just prepared one particular working note which is comprehensive, can cover everything. Because you'll get the fair value also, loss allowance also, the carrying amount of financial guarantee also, the gain or loss to be transferred to P&L also you'll get. So one working note will give you everything. So and it will work out for every circumstance. That's the reason I just made this working note and presented it in this particular format. This is optional. You don't have to present in like detail. Directly also you can get this. 10 lakh ka 30% is 30,000. Like that also you can calculate. Okay, now. So this is the funda about this particular problem. Good concept, easily. I mean, newly it is, now they have introduced this. Okay. Now if you are wondering, sir, so what is the journal entry in subsidiary books? So if you look at that, if you are interested, then the journal entries in the books of Moon Limited, the subsidiary will be, okay. Subsidiary is a simple, they have taken a loan, right? That means they will do simple loan accounting. They will pass the journal entry, bank account debit 10 lakhs to financial liability loan. What about this guarantee amount? For holding company, it is considered as investment in subsidiary. Okay, but for subsidiary company, you will transfer that off to other equity. Okay, it's like chance pay dance for them, no? They got the guarantee on their behalf easily. Yes, that is 73,311. They will credit this. Okay, so 10 lakh minus 73,311, if you calculate, you're going to get 9,26,689. Okay, that will be the financial liability value. So why not 10 lakh? No, financial liability loan value will not be 10 lakh because again, financial liability should be recognized at fair value. If you found out the fair value of that, it's just for your reference again. If you find out the fair value of this financial liability loan, if you want to calculate it, okay, same year cash flows. Here cash flow is different, so I'm using discount factor and then present value. Okay, so year 1, 2, 3, loan is 3 years. No? Third year again you have to repay principal. Cash flow will be what? Every year you have to pay 8% interest to the bank. So 80,000 is my interest I have to pay every year. Third year I need to also repay principal. So 10 lakh I have to repay. Okay, I'm finding out the present value of this. Present value of future cash flow will become my fair value at year beginning, right? Or initial recognition. Okay, so that at that value I need to recognize this. Now discount factor will be what? Discount factor will be if that guarantee was not given, I had to pay 11% interest rate, right? So you need to calculate this. You need to take this at 11%, mind you on that. So 1 divided by 1.11 if you do. So first year it will be 0.9009 and then here it will be 0.8116 and then it will be 0.7311 and third year again 0.7311. So if you find out the present value of this, it will be here it will be 7,31,191 and 0.7311 into 80,000 will give me 58,488. 0.8116 into 80,000 will give me 64,928. 80,000 into 0.9009 will give me 72,072. So if you total all this, you're going to get 9,26,679. 9,26,679. Small round off error. Okay. So that is the value you need to record your financial liability at. So basically this guarantee amount for parent, it will be investment in subsidiary. It will be considered as investment. For subsidiary, it will be transferred off to other equity as such. Okay. Same thing we have done in the group share based plan also. Yeah. That's all is accounting. Again, this is just for your reference. They have not asked this. In fact, I don't think so. They will ask the subsidiary also. And what about the loan? On this loan, normally you do ACM accounting. Okay, amortized cost table you put up and do the subsequent accounting. That becomes your normal problem. Okay. Anyways, this portion is important. Holding company ka. Okay. So that's what they had asked in this particular problem. Again, okay, initially recognize it at fair value. Subsequently, you will recognize this guarantee amount at fair value or loss allowance, whichever is higher of the two. Okay, take that and accordingly do the accounting. Any gain loss you will transfer it off to P&L each year. Okay, that's pretty much the thing that we covered in this particular problem. Okay, hopefully this concept is clear to you. Thank you.